In early 2021, something wild happened on Wall Street, and it all centered around a company you might know if you're into video games, GameStop. Hey taxpayers, it's Tiffany Gonzalez CPA here with not your typical stock market story. This was regular people in internet forums and a whole lot of chaos. So let's break it down. In early 2021, a video game retailer called GameStop became the center of a major stock market event, one that caught the investors' attention, regulators, and the general public. What happened wasn't just about stock prices. It raised questions about how the markets work, who gets to participate, and what happens when the internet gets involved. GameStop is a retail chain that sells video games, consoles, and accessories. However, as more gaming has moved online, and with the pandemic, many large investors believed GameStop's business model was struggling. Because of this outlook, some hedge funds and institutional investors decided to short the stock. And what exactly is that? Short selling is a strategy where an investor borrows a stock and sells it, hoping to buy it back at a lower price. If the price drops, the investor profits. But if the price rises, the investor has to buy the stock back at a much higher price, resulting in sometimes a very large loss. GameStop became one of the most heavily shorted stocks in the market. At that same time, communities of retail investors on platforms like Reddit began talking about GameStop. Some believed that stock was undervalued. Others saw an opportunity to challenge the hedge funds that were betting against it. They began buying shares and they encouraged others to do the same. As the stock price started rising, it triggered what's called a short squeeze. A short squeeze happens when the short sellers are forced to buy back shares quickly to recover their position. As the price rises, that buying activity adds more pressure and drives the price up even further. In GameStop's case, the price then soared dramatically over just a few days, from under $20 to over hundreds of dollars per share. This rapid rise caused massive losses for some hedge funds, and it created large unexpected gains for individual investors. But as the volatility increased, some trading platforms, most notably Robinhood, temporarily restricted users from buying more GameStop shares. This led to public outcry and even congressional hearings with questions about whether the markets were being managed fairly for all participants. The GameStop episode brought attention to several key issues: the power of online communities in influencing financial markets, the risk and consequences of short-term selling or short selling, and the ways trading platforms manage access during these volatile events. Some viewed this as a sign of democratized investing. Others saw it as a cautionary tale of speculation and market instability. The GameStop story was more than just a spike in a stock price. It highlighted the evolving relationship between technology, finance, and the everyday investor. It reminded us that in today's markets, information and momentum can travel faster than ever. If you found this breakdown helpful, don't forget to hit the like button, subscribe to our YouTube channel, and follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.